Amid the confusion and uncertainty, the lockdowns and protests all around the world, you may have noticed a curious development over the past few months: cheaper gasoline. Due to a glut of oil and fewer people on the roads, gas has become a lot more affordable. Here in Texas, we're paying as little as $1.50 per gallon. But what's good for motorists tends to be bad for the oil companies, many of which now have a crisis on their hands: a growing wave of restructurings and bankruptcies. Already a number of oil companies, including California Natural Resources, Oasis Petroleum, Fieldwood Energy, and Diamond Offshore, have announced restructurings in just the past month. And plenty more are said to be preparing Chapter 11 filings, including the one-time champion of American oil and gas fracking, Oklahoma City-based Chesapeake Energy, which has more than $9 billion in long-term debt. COVID-19 has only made existing problems worse for many industries. Oil is no different. BP is set to slash 10,000 jobs. Chevron and Halliburton are cutting tens of thousands more. Oil consultancy Rystad predicts that 73 international oil companies could go under in 2020, and 150 more are at risk for 2021. Some of these companies are entering bankruptcy restructuring for the second time in less than 5 years after the 2016 oil bust. Ken Coleman, who runs the restructuring practice at the law firm Allen & Overy, says there's one key difference this time around.
When the oil and gas industry last visited bankruptcy courts on a large scale, prices were down, but there was an ability to project, or at least people were comfortable that they had an ability to project future value. And then through the bankruptcy court and the bankruptcy process and the restructuring process, they could allocate that value among the various interest groups: creditors, secured creditors, unsecured creditors, and equity. The ability to project using the tools of financial analysis they're just not equipped to deal with this kind of situation. The difference now is the inability to value things and to project what their value may be 12, 24, 36 months out.
The Federal Reserve may help delay the wave of restructurings through its $750 billion bond buying program. And banks have also shown a willingness to extend and pretend. In other words, they're allowing borrowers to slide on their payments for a few months. Chris Atherton is the president of EnergyNet, which is kind of like an eBay for oil fields. He expects to see a wave of oil fields coming up for sale over the next 6 to 12 months, but it won't be completely like before.
I think the strategy going forward for a lot of companies is going to be kind of a shrink to grow. Many are going to be in survival mode. They're going to take a lot of different measures and steps to reduce expenses for their operations and really try to survive and maybe be the last man standing or last, in a smaller group. I believe there's 75 or 80 publicly traded oil and gas companies of size right now. I think unfortunately, it could be half that number in a year or two from now. And I think it'll be companies that shrink by reducing their staff, by laying off people, by reducing their drilling activity. They're maybe selling off some production. But if they do remain, if they do survive, I think they'll be better and stronger to fight another day down the road. And I think there will be quite a few companies that just simply won't be around in 3 or 4 years from now.